for Europe's economy, particularly Germany's export-oriented industry. Geopolitically, Europe finds a precarious position vended between Trump's isolationist policies and Putin's imperious ambitions to recreate aspects of the former Soviet Union. This new world order is taking shape before our eyes, more aggressive, populist, and anti-democratic than we could have imagined in a decade ago. It's also less predictable as autocratic and leaders like Putin show little regard to established international norms and legal agreements. The pressing question then is now the financial sector will navigate this fragmented, this really difficult environment. How will banks and financial institutions adapt to these mounting challenges? From a German perspective, we face additional unsustainable government coalition that has recently fractured. New elections on the horizon and concern in Frankfurt about the potential takeover of Commerzbank, our second largest bank, by UniCredit. Amid these challenges, there are also reasons for optimism. According to the latest Global Financial Centers Index, Frankfurt has risen to become Europe's second most important financial hub, trailing only London and securing a spot in the global top 10. That's a good news for us in the city. Employment in Frankfurt's financial sector has grown by 5.1% year on year, reaching 83,592 jobs of June 30, 2023. Furthermore, the establishment of AMLA, the European Anti-Money Laundering Authority, set to begin operations in 2025, is poised to create even more opportunities with the industry. Today's agenda promises thought-provoking discussions on these and many other pressing topics. I'm very happy that you're here in Frankfurt. We are particularly eager to hear the keynote address from great Madame Lagarde, and whose insight will undoubtedly provide valuable guidance to the road ahead. Thank you very much for your attention. Good luck for today. Thank you for coming.
Thank you very much, dear Mayor, for your kind greetings. The European Banking Congress is now in its 34th year, and as always, we are deeply grateful to the host banks, to Commerzbank, Deutsche Bank, BNP Paribas, and HSBC for their ongoing support and dedication. For the first time this year, after a virtual initiation 4 years ago, HSBC is chairing this year's conference live in person, and it is now my great pleasure to hand over to the chairman of the board and vice chairman of global banking at HSBC Continental Europe, Jean Bernardo. You have the floor. Welcome.
Thank you very much, Mrs. Crane. So great for all of us to be again in Frankfurt this year. Dear President Lagarde, dear Lady Dr. Mayor Eskandari-Grünberg, dear co-host Mr. Kotzbauer, Marchenil and Zewing, dear speakers and delegates, it is my honor to be introducing this 2024 European Banking Congress, which is the fruit of the excellent cooperation we have had with Deutsche Bank, Commerzbank, and BNP Paribas, as well as the city of Frankfurt. Once again, we have a fantastic lineup of speakers, and I would like in particular to warmly thank our regulators and monetary authorities for their highly appreciated presence, with President Christine Lagarde, Governor François Villeroy de Galhau, President Joachim Nagel. I also thank very much Minister Jörg Kukies, who has accepted to give a keynote at short notice. Last year, we had fascinating discussions under the theme Navigating in a World at Risk of Fragmentation. The fragmentation is happening, even if our world remains highly connected, integrated, and interdependent. And one of the biggest challenges for the European Union is to stay united in this environment, as well as to maintain close contact with our friends across the globe. We are in a banking congress, and it is important to highlight an important change from last year. Inflation has been largely fixed, and this is an acknowledgement of the big European success, the euro and its central bank. It should give us faith in our European capacity to tackle the future. The theme of this year, Out of the Comfort Zone, Europe and the New World Order, calls us to address this challenge, to continue progresses with the European single market, to strengthen European competitiveness, to set up a European vision of the world on international security, borders, trade and investments, among other topics. In her remarks last year on Capital Market Union, President Lagarde set a strong tone about it. We are fortunate this year to be able to feed our works with three crucial reports you all know well, by Enrico Letta, by Christian Noyer, and by Mario Draghi in September. Out of the comfort zone, we all know we are. The New World Order, on the other hand, is far from clear, with a new commission starting work, a new American presidency, a war on Europe's borders, an ongoing redesign of industrial investment and trade flows, a quite recent theme of savings allocation across the globe, which also naturally triggers the question of currencies' relative attractiveness. I am sure today's discussion will cover the European well-identified economic priorities, the need to promote innovation and improve productivity, the need to have deeper and broader pools of equity investment to support that goal, the need to tackle climate change as well as comparatively high energy prices in Europe, the need for more European sovereignty and strategic autonomy. Banks, such as HSBC and our co-sponsors, have to play their part in delivering on these ambitions. For HSBC, we started operations in continental Europe, not in Frankfurt and Paris, but in Lyon in 1881 and in Hamburg in 1899. Our strategy has not changed. This is to connect Europe with the rest of the world. Trade, investment, and capital flows are at the heart of our business, and even if it becomes more challenging in the next few years, we will continue. I wish you a great Congress.
Thank you very much to the Congress's chairman, Jean Bernardaud. Our next speaker has been urging Europe emphatically to move out of its comfort zone for some time now. As Jean Bernardaud just mentioned, we all remember, I think, her clarion call for moving forward with Capital Markets Union at last year's EBC. She has called the Draghi report's assessment of what needs fixing, I quote, severe but just, and said that while monetary policy will deliver price stability, and the ECB has done exactly that, it is no substitute for emphatic, bold political leadership. It is a great honor to welcome back to the European Banking Congress the President of the European Central Bank, Christine Lagarde.
Thank you very much. Dankeschön, merci, guten Morgen, good morning, and bonjour to all of you, and particularly to dear Mayor, Dr. Eskandari Grunberg. Thank you very much for having us in the beautiful city of Frankfurt. Dear, shall I call you doctor? No, maybe not. Mr. Bernardo, Mr. Kosbauer, Mr. Machnil, and Mr. Seving, and everybody else that I'm forgetting at the moment. But to all of you esteemed guests, thank you very much for having me again. And to those who find me a little bit repetitive and stubborn, you will not be disappointed. Because at last year's conference, I spoke about Europe's fragmented capital market and the urgent need for us to integrate those markets. And the main thrust of my argument, you have mentioned that, was that Europe was facing transformative changes that came with huge financing needs. I don't need to repeat them, you remember. And I draw the analogy with the railroad developments in the United States, which prompted the capital market. And I also mentioned last year that we would not succeed without mobilizing private capital much more effectively. And I called for this Kantian shift in how we approach the capital market union project, moving away from the bottom-up harmonization to a top-down integration. But as Martin Luther King said, we are now faced with the fact that tomorrow is today. And in that time, the urgency to integrate our capital market has just risen. Since last year, Europe's declining innovation position has come more clearly to light, notably because of some of the reports that you have mentioned, Mr. Bernardo. And the technology gap between the United States and Europe is unquestionable in a direction that we should not be proud of. So the geopolitical environment, as you have mentioned, Madam Mayor, has also become less favorable with growing threat to free trade from all corners of the world. And as the most open of the major economies, Europe, we are more exposed to those trends than many others. I will call Capital Market Union from there on CMU, so it will spare you a little bit of my repetitive anthem. CMU lies exactly at the center of all these challenges, in my view. And it is key for making our economy more dynamic and technologically advanced. While banks, you, play an essential role in the European economy, we know that integrated capital markets are needed for financing, in particular, early-stage breakthrough innovation. And it is key for becoming more resilient in a fragmenting world economy. Capital markets, in our view, is the missing link for Europeans to turn their high savings, more on that later, into greater wealth, which will ultimately enable them to spend more and strengthen internal demand. My macro is coming back here. However, this growing urgency has not been matched with tangible progress towards CMU, in large part because its implementation remained very loosely defined. Since 2015, when we first started seriously talking about CMU, since 2015, there have been more than 55 regulatory proposals and no less than 50 non-legislative initiatives. But that breadth has come at the expense of depth. It has allowed CMU to be picked apart by national vested interests that see one or another initiative as a threat to their territory and some of their mandates. So if we are to achieve a conscience shift, in my view, we need to refocus. Exposing the core inefficiencies in the system, yes, and identifying a smaller number of initiatives with the highest possible return. And as I see it, the core problem of CMU is that the pipeline from savers to innovators is blocked at least at 3 key stages. And that's the reason why I called my speech, Follow the Money. I know it resonates with other things, but this is literally. So those 3 key stages are: number 1, entering; number 2, expanding; number 3, exiting. What do I mean by that? First, European savings are not entering capital markets in sufficient volumes because they are concentrated in low-yielding deposits. I'll come to those 3 in a moment, specifically. Second, when savings eventually reach the capital markets, they remain trapped in national silos and they're not expanding throughout the European community. Third, once savings have eventually been allocated by capital markets, they are not exiting towards innovative companies and sectors owing to an underdeveloped system for venture capital. So there are 3 blockages, bottlenecks, if you will, that require different solutions, but they must be seen as a single problem because they are self-reinforcing. Fewer high-growth companies means lower equity valuations and liquidity in the European Union markets, and lower returns for savers. So in my remarks this morning, I will outline the key blockages I see in each area and present some proposals with great humility, because I'm sure that there are other ideas and proposals that are out there, and maybe they're much better than mine. But I think it's about time that we actually put chips on the table and consider them, rather than just have general views about the shortage that we have here in Europe. So let's talk first about entering the capital markets. Europeans have a high share of their income, about 13%, high share of that income is actually saved. And this is much more than the Americans. In 23, we, the Europeans, we saved about 13% of that income when the Americans were saving 8%. That's in 23, and that's pretty much a standard trend. But typically, Europeans favor low-risk, liquid saving products. In Europe, approximately 11.5 trillion is held in cash and deposits. I'm talking here about the stock. This is 1/3 of households' total financial assets. If you compare that with the United States situation, it's 10% for the US. So that has 2 main consequences for our economy. 1, European households are much less wealthy than they could be. Since 2009, post-financial crisis, US household wealth has grown by around 3 times more than that of the European Union households, 3 times. Now, some of you will dissect that and will say, oh, it's all about some of the Magnificent Seven in which American households eventually have invested, and as a result of that, we have the difference. Not only. Second consequence, the flow of savings into capital markets is much lower than it could be. According to our analysis, if European households were to align their deposit to financial assets ratio with that of American households, a stock of up to 8 trillion euros could be redirected into long-term market-based investments, that's in stock, or a flow of 350 billion euros per year. So why are people not diversifying their assets? You probably have ideas about it, but I'll propose mine. One of the key issues is that retail investment in Europe is fragmented, opaque, and expensive. In many countries, investing is complex and intermediated by financial advisors that people do not always trust. 45% of consumers say that they are not confident that the advice they receive is primarily in their best interest. And if households do invest, they often do not get the best deal. Retail investors in Europe, in mutual funds, for example, pay almost 60% more in fees than their US counterparts. Many Europeans, therefore, end up investing in guaranteed saving accounts by default. But this is not in the DNA of Europeans because they would be more risk-averse. No. Because when markets are a bit more competitive and consumers can choose from a wide range of suitable investment products, behaviors do change. In the Netherlands, in Sweden, in Denmark, households manage their assets in a similar way to that of their US counterparts, holding only about 10 to 20% of their financial assets in liquid form. So if we are to unblock the entry stage of the pipeline, we need savers in Europe who have products that are accessible, transparent, and affordable. In my view, a European saving standard, a standardized EU-wide set of saving products, if you will, is one way and maybe a good way to achieve these goals. Without adding to the bureaucracy, I get that. But if properly designed and distributed, these products would be accessible, simple to understand, available everywhere, and offering a range of investment options. They should be transparent because they would be structured according to clear criteria such as diversification, fee structure, and portfolio composition. And they should be affordable because financial services providers would be able to offer EU-certified products with less red tape, while standardization would lead to more comparability and probably more competition. Both effects would probably bring down the fees. The attractiveness of the European standard should also be enhanced by harmonizing tax incentives across countries. And this does not belong to your community, it belongs to policymakers, and they should not be shy about that. They should be courageous. Then the market should decide where savings are directed, not the governments. But depending on the preference of savers, products could also be offered that would support European priorities such as financing innovation and the green transition. That's for the entering into the market. Let's just now look at the expanding throughout Europe. Because to truly unlock Europe's innovative potential, which exists, we need finance to flow where the best ideas are. And given the nature of digital technology and the impact that it will have, which often requires large upfront investment, we need those flows to be in large volumes. And the second stage of the pipeline, expanding throughout Europe, is also blocked. Second bottleneck. We observe that capital in Europe is either trapped within national borders or leaves to the United States. If we look at equities, for instance, more than 60% of households' investment in Europe takes place within their own country. And if you look at institutional investors, they invest much more in US markets than they do in the European Union. There are many reasons for this segmentation of European markets, but a key one is that our financial market infrastructure are extraordinarily fragmented. In 2023, bear with me, I'm not making a mistake on the number. In 2023, there were 295 trading venues in the European Union. 295. There were 14 central counterparties and 32 central securities depositories. I was going to bring a slide, but it's not done for the president of the ECB, so I did not. But I have a drawing that I will frame in the hope that within a few years it is a little less artistic. And that drawing includes the 295 and the 14 and the 32. And it makes for a beautiful drawing, but not a very simple sector to navigate. In the United States, there are only 2 securities clearing houses and 1 CSD. Now, many CCPs and CSDs belong to pan-European cross-border groups, but national exchanges remain largely separate, despite some technical synergies like consolidated order books. This fragmentation creates high transaction costs for cross-border trading, which, according to ECB analysis, increases home bias in how investors allocate their funds. That, in turn, leads to lower liquidity for investors, issuers, and stock exchanges. Compared with their EU counterparts, the average daily trading volume per company is 1.3 times higher for US large caps and 2 times higher for US mid caps. So, what is driving this fragmentation? Again, you will have ideas and views on this, but let me put out mine. The main issue is that legal frameworks within the EU are divergent, and all meaningful attempts at harmonizing are blocked again by vested interests, often of a national nature. And national authorities tend to exacerbate rather than reduce this problem. For instance, there are some member states that mandate the use of national CSDs for issuing securities under national law or for settling primary issuances of sovereign funds. This melange of different regimes and enforcing parties severely limits the ability of exchanges and CSDs to integrate their national platforms, even within cross-border groups. Although I know that there are some movements in that area, and I applaud them. Progress is being made, yes. Europe is moving towards a common consolidated tape, which will help reduce transaction cost. This tape could reduce trading costs by about 40 to 60% by increasing transparency between dealers and investors. But it will not address the fundamental problem, which is that our incremental approach focused on harmonizing a multitude of national law of different categories, which involve different ministries in different settings, simply either doesn't work or works way too slowly. Again, looking at the other side of the pond in the United States, legal convergence often does not come about through total harmonization of state-level laws, but rather through federal law being introduced or one state's law becoming dominant. For example, almost 80% of all US companies that held an initial public offering in 2022 were incorporated where? In Delaware. You know that. In Europe, we will not be able to make progress by promoting one country's legal system over another. And that is why I called for a European SEC in my speech last year, and I reiterate, and I believe very much that it could be transformative, and it could well be organized as a network of offices throughout the member states. We can be creative in that respect. But there are 2 main ways that we could achieve a change in method. because alongside this goal, there are other options to pursue. It does not detract from the fact that a European SEC is a move forward that I believe will trigger a lot more, because supervision moves initiatives. So one of those two other options would be to adopt a two-tier approach, as we have for competition enforcement in Europe, or for banking supervision, as you know well, with the SSM. Entities that meet certain criteria would automatically fall under EU jurisdiction and within a common Europe-wide legal framework, with cross-fertilization of the legal systems under the authority of one key entity. Another option would be to use the 28th regime, much talked about in both the Draghi and the Letta report. That could enable us to carve out a special legal framework in areas where progress has stalled. We would then have a separate EU legal regime that firms can opt into, sitting alongside the various national regimes. In my view, the most realistic approach probably involves some combination of all that I have just mentioned. For example, to bypass the cumbersome process of regulatory harmonization, we could envisage that 28th regime for issuers of securities. They would benefit from a unified corporate and securities law, facilitating cross-border placement, holding, and settlement. But such a regime, as attractive as it sounds, and as a bit of a cop-out from the difficulty of harmonization, would, in my view, be unlikely to work for supervision, as it could lead to inconsistent enforcement and misaligned incentives if entities choose their own supervisors under an opting-in system. So here, we could envisage a two-tier approach or a single but decentralized approach. Financial services providers that fulfill a set of criteria, such as size or cross-border activity, would fall under European supervision, a shift that I called for at this event last year, remember. National authorities would continue to supervise smaller national players. Close collaboration between the European securities and market authorities and national authorities would be essential for success and would maybe move us further, because this is not going to happen overnight. So much for expanding. Let's look at the exiting, and that will be my third and last set of propositions. Because even if we get capital moving more freely within Europe, we still need to ensure that it exits the financial system into innovative sectors and companies. That's the whole point. And this is the third stage of the pipeline, which is currently blocked as well. In highly innovative economies, there is typically an ecosystem of investors, angel investors, well, let's start with the family, but it's then angel investors, venture capitalists, private equity funds, and that ecosystem channels funds to high growth startups, mostly through providing equity. And this ecosystem is much less developed in Europe than it is in the United States. VC investment is only around 1/3 of US levels of venture capital. The upshot is that innovative young firms struggle to grow in Europe, especially once they reach the scale-up phase, where larger funding rounds are needed. The median European VC-backed company receives around half as much funding as its US counterpart in the same sector of activity. And we are largely reliant on foreign venture capital to fund European innovation. More than 50%, 50, of late-stage investment in European tech comes from outside the European Union. Something wrong with that? No, we welcome, as an open economy, investment from all parts of the world. But if the EU tech entrepreneurs, and we have many of those, receive mostly outside funding, it creates an ecosystem of its own. It creates a path dependency. And these founders may ultimately decide to list and grow their businesses elsewhere, particularly in the US market. And this is what I would call the unintended exit. So what can we do to close that financing gap? Let me look at it from a demand and supply perspective. Fixing the demand side is key. There are too many barriers and bureaucratic hurdles for entrepreneurs in our single market, which means that there are fewer high-growth companies and VCs that want to finance them. If you look at the Letta or Draghi report on completion of the single market and improvement of our competitiveness, it is obvious and full of very, very clear examples. But we also need to work on the supply side. And since we are starting from a deficit position, we need to use all the flexibility we have within the European financial system to unlock funding for innovation. Let me propose 3 changes that could make a difference. I'll be short for each of the 3. First, given the natural alignment of investment horizon, our regulatory regime should allow long-term investors to contribute more to long-term growth. For example, European Union pension funds allocate just 0.02% of total assets to venture capitalists, compared with almost 2%, so 0.02 for us, 2% for US pension funds. And this percentage, don't forget, is applied to a much larger base in the United States. Over 140% of US GDP, compared with around 30% of European GDP. First proposition. Second, we should fully harness the potential of our public development banks, especially the European Investment Bank, to pool risks and crowd in private capital. Not cried out, cried in. Successful initiatives are already afoot. Last year, the European Investment Bank and 6 member states launched the European Tech Champions Initiative, a fund of funds aimed at channeling late-stage growth capital to promising European innovators. To date, the fund has mobilized 10 billion euros in public and private resources and supported 16 tech scale-ups. This is significant, considering that in 2023, European scale-ups received around 30 billion in venture capital. So a third. But more can be done to unlock the EIB's potential and enable us to catch up with our peers faster. In particular, the EIB should be allowed to use its resources more effectively and provide a wider variety of instruments to support breakthrough innovation, especially when it comes to supporting early-stage startups. I welcome those changes if they happen. Third proposal, we should explore how to support innovation not only through equity, but also through debt. While Europe should ultimately aspire to have quasi-US levels of VC investment, in the meantime, because it will not happen overnight, we need to make the most of our solid, reliable, bank-based system. Banks can play an even better role in financing innovation. One interesting development in Europe over the past decade that you have instrumented has been the rise of venture debt. Venture debt loans that provide liquidity to startups between equity funding rounds. In 2022, around 24 billion euros in venture debt was allocated, and that is up from only 1 billion 10 years ago. But if banks are to lend more to riskier sectors without compromising on prudential regulation that has been helpful so far, they need the balance sheet space to do so. And in that regard, developing securitization in Europe could support that. European banks currently lend more than 600 billion euros to real estate companies, but less than 100 billion euros to technology companies, even though the contribution of each sector to real value added is around the same. tools that could facilitate some rebalancing of these exposures could support innovative activity in Europe. So let me move out of my comfort zone and speak Italian with you, because I want to quote at this point Leonardo da Vinci. My colleague Piero Cipollone, who is here, can correct me. So Leonardo da Vinci said, "Il sapere non è sufficiente, dobbiamo applicare. Il volere non è sufficiente, dobbiamo fare." Which, poorly translated, means that knowledge is not enough. We must execute. And will is not enough. We must act. More or less okay? Thank you. You know, I could actually stop here because it's all in there. We must execute, we must act. It's not enough to know about the issues we have and to have the proclaimed will to go about it. We must do it. So, I think, by the way, I think European leaders know the problem. I was at the Budapest meeting of the European Council about 10 days ago, no, 2 weeks ago exactly to this day. And I showed them the map of our financial sector, the 295 exchange and the rest of it. And some of them were flabbergasted. And I think they understand the need to make sure that the money flows, the money that we have just followed during those remarks. So if there is that political determination, and if leaders can bypass the vested interests that are protected like fortress in the ancient ages, we might have a chance to move from discussions, speeches, however good they are or well presented, to actual action, which matters a lot more. I think we have the choice of either see people eat our lunch, be their lunch, or create our own cuisine. We can do that well. Thank you.
Thank you very, very much, President Lagarde, for that very clear call to action. And good cuisine, of course, always needs a prise of salt and some nice spices. And you've spiced your remarks also with optimism about Europe's ability to actually implement the changes you recommend. And I think that's very welcome at this time of soul searching for Europe. So many thanks to you for that. Before we continue, dear guests, we would like to remind you that we want to sample your wisdom, the wisdom of the crowd, and therefore I would like to test your devices. So please take the devices that you found at your places, and we have a test question for you, which hopefully we will see shortly. The question is, which of these TV series best prepares us for the new world order? You may not have seen them all, but the titles do tell you something. And we've tried to give a nice international cuisine here. So please make your choices now. You haven't seen Succession? You haven't seen Diplomat? These are great shows. And Dans l'Ombre has quite a disturbing plot. Essentially, in France, an election is rigged to prevent a certain politician from coming to power. Can also recommend that one. So, the diplomat, very nice. She's always struggling to get ahead of the challenges, but sometimes she succeeds. 30% see Succession, that's a dark one, but of course we do have some very